What's up guys, first video and I'm going to show you my portfolio of ASX listed stocks. Now, if you're anything like me, you're thinking, why should I give a shit about your portfolio? I'm just some random guy on YouTube, I'm not Warren Buffett, I don't own a Lambo, I'm probably just some bag holder who is trying to pump and dump his awful stock picks to make up for his own bad decision making. And if that's not what you're thinking, it probably should be. 9 times out of 10, people who talk about investing are the people who couldn't make it investing. Because if you're good at investing, you already have money. You don't need to bust your ass writing, recording, and editing YouTube videos to make 20 cents per year in ad revenue. Instead, the people who are good at investing just open their brokerage account, print $3,000 out of thin air selling covered calls on their gigantic portfolio, and then spend the next 30 days enjoying sweet, sweet unemployment while they wait for them to expire. So if my portfolio is worth the paper my holding statements are printed on, why am I here busting my ass writing, recording, and editing a YouTube video? And the answer to that is clout. I am literally just doing this for the sake of my own ego and no other reason. Back when I worked as a software engineer, I had a whole team of people around me who shared in and respected my work. On a daily basis, I would hear things like, wow, you got that done fast, and that's a clever solution. I would even get the implied clout of having people consult me about how a certain system worked or how to hunt down a certain bug. That's not to say that I was some kind of guru at my old workplace. All of us were equals more or less, but the others had their areas of expertise and I had mine, and it was gratifying to be recognized for that expertise. These days, however, I have chronic fatigue syndrome, and I'm too sick to hold down a regular job. Not only that, but my wife does as well. Investing ain't just a side hustle for me, it's the only thing standing between us and a life of poverty. But as it turns out, I seem to be pretty good at it. In an age where even getting approved for a mortgage is an impossible dream for most 31-year-olds, I skipped the mortgage step entirely and bought my first home in cash. After a Giga Chad move like that, you might think it should be easy to fish for compliments amongst my friends and family, but money can be a bit weird like that. A lot of my friends and family are doing it tough financially in their own lives, and the last thing I want to do is rub my wealth in their face, especially because I can't afford to be generous with it. If a normal person hits a big windfall and they spend it irresponsibly, they can always go back to working at McDonald's to get by. But for me, McDonald's isn't an option. I have chronic fatigue syndrome. This money, for better or for worse, has to last me for the rest of my life. I have to pinch every penny. This money is something that I have to grow and protect and stretch out until it is enough to pay for the next 60 years of me and my wife's lives. Then, and only then, can I afford to be generous with it. Because until then, every dollar I give away just brings us a little bit closer to ending up on the streets. So that's the situation. This channel is going to follow my investing journey. The stakes are high, the trades are real, and hopefully you, the audience, will be able to learn a thing or two along the way. Each episode I'm going to explain my investment thesis behind the picks, my rationale behind any trades I place, and my outlook for the future. All I ask in exchange is that you give me clout by watching my videos and posting the occasional comment. My wife is my biggest cheerleader, but you can't keep making her do it all by herself. So here's the raw spreadsheet with all the gory details. You can pause the video here if you really want, but I think most people are going to prefer a slightly more digestible format, so here's some bar charts. Oh gross, the charts export in light mode? Hold on, that's better. As you can tell, while my portfolio is diversified across quite a few tickers, AKE is the lion's share of my holdings. AKE is a major lithium company, and it is what paid for most of my house. I'm still bullish on this company, and I'm happy to have a large holding, but I want to own less of it for a few reasons. 1. Diversification. I'm sick of having my entire portfolio pulled around by one stock. It's bad from a risk management standpoint, but also it's just super annoying that every day when I log on to check my portfolio, the entire thing is red or green based entirely on what this one company has done for the day. However, I've already sold some this financial year, and if I sell too much more, I'll be on the hook for a big tax bill. Paying tax that you don't need to pay is a great way to make a 10% loss overnight. So for that reason, I'm going to hold most of this parcel until next financial year. The part of it that I'm willing to sell, I'm not going to sell outright, but instead I'm going to sell covered calls on them until they either get exercised or the next financial year arrives. If you don't know what covered calls are, don't worry about it. Just think of it like I'm collecting a small fee in exchange for letting somebody else decide when I have to sell these shares. This explanation is honestly so half-assed that I'm not willing to call it half-true, but it's the easiest way to think about what I'm doing with these shares if you don't know what covered calls are. Last month I made a bit over $1,000 doing this, and I'm hoping to keep doing it as long as I can before I'm forced to sell them, but we'll see how this goes. Out of all these stocks, AKE and SEN are the two holdings that I've held for a while, and the rest of them are all tickers that I've bought relatively recently as part of a major portfolio rebalance that I started in July, when the beginning of the new financial year arrived. For this reason, I'm going to discuss these two stocks a lot less, as they're more on their way out, and I'm going to focus a lot more on the stocks that are on their way in and that I'm excited about for the future. My next biggest holding is CAA. This is a small manufacturing firm that extrudes aluminium for construction, shipbuilding, and other applications. A few years ago, they made some major structural changes to the business that resulted in much lower costs, and they are absolutely printing cash. Like truly obscene amounts of cash. When compared to their valuation, it's just insane. Anyway, despite this, most likely because their market cap is so small, it seems like the market has mostly been ignoring them for the 2 years since they made these changes. Recently, however, they've started to move, likely due in part to the fact that they're putting some of their profits into a buyback. Out of all the companies in my portfolio, this is the one that I am the most excited about, and I can easily see this netting me 20 or 30% over the next year. The dividend yield is very good as well. After that, we have CRN, which is a coking coal company. Not to be confused with thermal coal, coking coal is used for steelmaking. Every coal-fired power plant in the world could shut down tomorrow and the world would still need coking coal. I don't know exactly why their valuation is so low, but once again, this company is printing money, and it has the added benefit of being a large enough company that I can use it as margin collateral for my options shenanigans. Then there is SEN, which is a cybersecurity company. This is my dog stock. I've been bag holding this for a couple of years, but I actually still believe in the company, and I think there's a lot of upside potential, so I'm happy to let it keep stinking up my portfolio for a couple more years just to see if they can deliver the goods. I'll probably talk more about this one if the price ever does anything interesting, whether that be up or down. For me, this is that bottom drawer stock that you just don't think about very often and you don't really want to think about very often. Next up is TWD, or Tamerwood, which is a residential construction firm. I actually love this company, even though they are the least profitable out of all my newly held stocks. The two main reasons for that are, one, they have very good management who successfully steered the company through an industry crisis without ever making a loss even. Meanwhile, their competitors were going insolvent one after another. Secondly, most of their competition has just straight up gone out of business, so they are one of the last companies standing who is going to grow into that empty space that's been left behind and scoop up all of that market share. Then we got Hum, which is just some run-of-the-mill finance company that does small and medium enterprise lending. The market hates them because they set a bunch of money on fire trying to get in the buy now, pay later craze, but they've shut down all that garbage, and what's left behind is actually a very profitable company. My holding is very small though, because I'm not 100% sure they've got their shit together. If their next half-yearly report is positive, it's quite likely that I'll add more to this position and bring it up closer in size to my TWD holding. Next up is BIS, who make quenched and tempered armored grade steel. They're a nice little bit of military-industrial complex exposure. Military spending is up all across the globe thanks to Putin's shenanigans in Ukraine. Screw that guy. But hey, if the world is going to squander resources on needless warfare, regardless of what I do, I might as well take a cut, right? Then last on the list is BFL. BFL is essentially the Bank of Papua New Guinea and a scattering of other islands. They are, like most companies on this list, very profitable, and I'm bullish on the adoption of banking in cash economy emerging markets. The reason I own less of them than any of the other companies is not because I like them less, but rather because when I had capital available to invest, they happened to have spiked up by like 12%. And I was expecting a retrace, so I didn't want to go in too hard just to immediately watch the price tank. As expected, it did retrace, and I'm currently down 5% on this position as a result, but I was expecting it, so I allocated very little money. I'm only down by like $250, so the next time I have some capital free, I will get to add to this position at a more favorable price and bring my average down. So those are the picks. How have they been doing so far? It's been about 2.5 months since my portfolio rebalanced, so a lot of this is just noise. In particular, CRN has been so volatile lately that if I woke tomorrow and that 2% gain had turned into an 8% loss, I wouldn't even be that surprised. Likewise, most of that big gain in BIS happened just in the last day, so I'm not sure if that necessarily is going to stick around, but in general, the portfolio was broadly positive. CAA, like I said earlier, is my favorite pick out of all of these, and it's been performing exactly how I hoped it would. Just slow and steady gains, up by almost 10%. And if you switch over from the percentages to the raw dollar values, it looks even better. My two losing positions are my smallest, and my CAA position is my largest by far, meaning that on a raw dollar basis, the new portfolio has been making absolute bank this last 2.5 months since I created it. In fact, some of these stocks have gone ex-dividend during this time, meaning that there's another $1,200 coming in the mail that's not even shown on this chart. All in, including dividends, my return on the new holdings has been 5.9% in 2.5 months, compared to 1.23% gains if I had just held the whole market ETF over the same time. Now, it would be pretty dishonest of me to do a comparison to the market and exclude two of my largest holdings, so let's talk about the elephant in the room. Yes, AKE is half of my portfolio. Yes, it went down since the start of the financial year, by a lot. However, this is mostly just because the first day of the financial year marked pretty much a 52-week high for this stock, and it is volatile as all hell. If we're comparing it over the same period as the new portfolio, I would have to say I'm down like $20,000 on this position. But if you zoom out to the 2-yearly chart, and I've been holding this stock for over 4 years now, this is really just normal fluctuation for this stock. What's more, over the last few months, I made $4,000 selling out of the money options over this holding, something that I don't really want to explain how it works just yet. My expectation for this stock is that it's going to bounce somewhere between $11 and $16 for the next year, and I'm just going to milk it for all it's worth, selling out of the money options over it during that time. Unless it drops below $11, I'm not going to lose any sleep about this holding. I'm not a chartist, I don't do TA or candlesticks or what have you. I am a buy and hold investor. I am not trying to predict what is going to happen in the next month, so I don't beat myself up over monthly moves. What I beat myself up over is if I pick a company that I think is going to earn a lot of money and then its earnings fail to meet my expectations. That is how I know I've messed up. Which is how I know I messed up buying Sen. Anyway, this is my first video, so I had lots of stocks to introduce and I had to be very brief, but in later portfolio updates I plan to do deeper dives into analyzing each of these companies and explaining more of my logic behind holding them. This is my first time making one of these videos, so if you want to see more of this sort of thing, please leave a comment. There is no guarantee I'm actually going to make more of these videos because, like I said, I don't need the ad revenue. I don't need you to sign up for my Patreon. I'm not trying to sell you an options trading course. I literally just need you guys to give me attention, so you better get to it. Alright, thanks for watching. Have a good one.